So when CFOs are doing cost containment measures, the one thing that I will share is there is an openness to spend money on technology issues today that will lead to greater efficiencies tomorrow.
Joining me today is Jim Wittmer, National Managing Partner, Tax Growth with Grant Thornton. Jim, thanks so much for joining us today.
Thanks, Matt. Pleasure to be here.
Now, as you look at the current landscape, what do you see as the most prevailing tax issue facing REITs?
First is the redemption issue, which is there's been a run on the bank in this sector, in this industry, if you will. So a lot of things helping taxpayers manage the taxability of the distributions. We'll come back to that. Second piece is, well, all the competitive natures of the different properties, there's been an influx of services that happen. And those services can, if risen to a high level, can lead to bad income, which could lead to a disqualification of REIT status. And the third thing is more about being proactive and looking forward, more from a governance perspective. While the transactions have slowed in this sector, in this industry, looking forward to what the M&A will look like and what taxpayers should do or consider doing to increase and enhance the value is important. So I'll come back to the first piece. The redemption side, depending on when one is a private REIT or a public REIT, there's different answers. So what happened? Well, high interest rates, inflation has caused a suppression on the amount of transactions. One of my clients told me he analogized a REIT to being a shark. And if you can imagine a shark, it's happy. It goes on its path, and as long as it's eating, i.e. acquiring properties, all is well. Well, there's been a slowdown in the market, so that's caused some pressures. Those pressures come in the form of investors want to potentially redeem out. They think they can get higher returns in different sectors in their portfolios. The redemptions often came at a cost. Those costs are taxpayers would sell a property, they'd have an increased gain, and that would cause an inflection point in terms of how the distributions to the shareholders are treated. They're treated three ways: either ordinary income, capital gain income, or return of capital. And so what we've been doing is helping different taxpayers manage the return of capital percentage. So with these transactions, because the shark stopped swimming, how do you generate deductions to manage the investor expectations? Not so much of an issue for the publicly traded REITs. You and I could exchange shares and life is fine. But in the private sector, it's a little bit different. And so that is a big issue that we're helping it. I'll move on to the second part, which is it's called impermissible services. So think about all the things that happen at a property level. There could be fitness facilities, cleaning services, coffee kiosks, cell towers on tops of buildings. Think about all these services right now. And there's not a lot of guidance out there. So as you're trying to entice people to come back to offices, people to attract your building, if it's multifamily, tax professionals within this REIT sector are worried about what's termed impermissible services. Because if the services are too significant, it could cause one to lose its status as a REIT. So that's an issue that's being addressed right now.
Last month, Grant Thornton released its latest CFO survey. How do you think REIT CFO confidence levels are compared to peers in other industries?
I would say that the CFO expectations within the REIT and real estate industry were lagging overall compared to CFOs in general. Now, why is that? It's largely because there's not a lot of transactions right now. Everybody's expecting the Fed to lower interest rates. We will probably see 3 interest rate drops between now and the election later this calendar year. But definitely the CFO outlook from the real estate sector has been softer compared to others. But it's cyclical. I expect it will change. And as soon as some of the things break in the market and the transactions start to flow, you'll probably see a bit of an uptick in their expectations.
And lastly, what role do you see technology playing in assisting CFOs and the overall REIT tax function?
A couple things that I would say about that is culturally, are the clients, are the taxpayers open to change? So when it comes to technology, sometimes people get scared off of those things. And so there is a willingness to do exactly what they did in the prior year. But that's not necessarily going to be a great answer. Another thing that I would say about technology is from the tax side of the house, we rely on using certain software package to get good information. Well, if you don't have good information and you apply technology to bad information, I think we all can say where this story will end.